Hey everyone, and welcome back to Finance Daily. Today we're doing something a little different.
Oh,
We're taking a deep dive into one of the most celebrated investment books of all time,
sounds exciting. Which one?
The Intelligent Investor by Benjamin Graham.
Ah, a classic.
We had a lot of requests from listeners to do this one,
Makes sense. It's a must-read for any serious investor.
and we figured, what better way to become well-informed on a topic
Yeah,
than to really unpack it in a deep dive?
absolutely. It's like a shortcut to absorbing all the key insights.
Right. So whether you're a seasoned investor or just starting out.
There's something in The Intelligent Investor for everyone.
Exactly. It provides a solid foundation for making sound investment decisions.
Couldn't agree more.
And to help us navigate this deep dive, we've got a financial expert here with us today.
Hi, everyone. Glad to be here,
By the way, if you want to follow along,
which I highly recommend.
you can find a link to The Intelligent Investor on Amazon in the description.
Get the discount just for our listeners.
Now, we know The Intelligent Investor can be a bit of a dense read,
It's packed with wisdom, but yeah, it can be challenging.
so we're going to break it down into manageable chunks.
And highlight the most important takeaways.
One of the first things that stood out to me was Graham's distinction between investing and speculating.
Ah, yes, that's fundamental to his whole philosophy.
It's not about chasing hot stock tips or trying to time the market.
Right, it's about making calculated decisions based on a deep understanding of a business.
So for Graham, an intelligent investor is someone who analyzes businesses, not stock charts.
Exactly. They're looking for undervalued companies with solid fundamentals.
And this is where his famous Mr. Market analogy comes in.
Oh, that's a great one. It perfectly illustrates how an intelligent investor should react to market fluctuations.
Can you explain the Mr. Market analogy for our listeners who haven't read the book?
Sure. Imagine you own a business, and every day this guy, Mr. Market, shows up offering to buy or sell shares of your business.
Okay, I'm following.
The catch is, Mr. Market is incredibly emotional.
I see where this is going.
Some days he's euphoric, offering ridiculously high prices for your shares.
And other days he's depressed, wanting to sell his shares for pennies.
Exactly. And Graham says the intelligent investor shouldn't get caught up in Mr. Market's mood swings.
It's about taking advantage of his irrationality.
Precisely. If Mr. Market is offering a crazy high price, maybe it's time to sell.
And if he's panicking and selling low, that's an opportunity to buy.
It's about being disciplined and rational, not letting emotions dictate your investment decisions.
Now, Graham also talks about two types of investors, the defensive investor and the enterprising investor.
Yes, these categories reflect different levels of risk tolerance and time commitment.
Can you briefly describe each type for us?
Of course, the defensive investor prioritizes safety and simplicity.
They're not looking to spend hours poring over financial statements.
Right. They want a portfolio that requires minimal effort but still delivers solid returns.
And the enterprising investor.
They're more hands-on, willing to put in the time and effort to research individual stocks.
So they're more like financial detectives, looking for those hidden gems.
Exactly. They're seeking undervalued companies with strong potential for growth.
This is where Graham's concept of margin of safety becomes crucial.
Ah, yes. Margin of safety is one of his most important principles.
It's like a buffer that protects you from potential losses.
Can you elaborate on that a bit more? I think it's a concept that a lot of people struggle with.
Sure, it essentially means buying assets for significantly less than their intrinsic value.
Like getting $1 for 50 cents.
Exactly. The bigger the discount, the lower your risk.
Because even if your analysis is slightly off, that margin of safety helps protect you.
It's a brilliant way to minimize your downside.
It's all about managing risk and protecting your capital.
Now, I know a lot of people are curious about the dogs of the Dow strategy.
Ah, that's an interesting one. It gained a lot of popularity.
Can you explain that strategy and what Graham thought of it?
Sure. The Dogs of the Dow strategy suggests investing in the 10 Dow Jones Industrial Average stocks with the highest dividend yield.
The idea being that these dogs are undervalued and poised for a rebound.
Right, but it's important to note that this strategy was added to a later edition of the book, not by Graham himself.
And it's not without its risks.
No strategy is foolproof,
Graham always emphasized that market conditions change.
and investors need to adapt,
He was a huge advocate for continuous learning.
especially in the ever-evolving world of finance.
So let's talk about another critical aspect of investing that Graham emphasized,
What's that?
inflation.
Ah, yes. Inflation can be a silent wealth killer.
He seemed to see it as a major threat, particularly for certain types of investments.
He did, especially for fixed income investments like bonds.
Why is that?
Well, if you're earning a 5% return on your bonds, but inflation is running at 6%.
You're actually losing money in real terms.
Exactly. Your purchasing power is being eroded.
So how did Graham suggest investors protect themselves from inflation?
He believed in owning businesses with pricing power.
Companies that can raise prices without losing customers?
Exactly. Think of companies like Coca-Cola or Procter & Gamble.
People keep buying their products even if prices go up a bit.
That ability to pass on costs to consumers is really valuable during inflationary periods.
It's not just about owning any stock, it's about owning the right stocks.
Stocks that can withstand economic headwinds.
Now, one thing that really stood out to me was Graham's skepticism of new era thinking in the markets.
Oh, yes. He'd seen it all before. Investors getting caught up in hype, ignoring fundamental valuations.
And convincing themselves that this time is different.
It's like they forget that market cycles are a thing.
And those bubbles always burst, don't they?
They do, and that's why Graham's principles are so timeless.
They help you avoid getting swept up in those market fads.
It's about being a contrarian, being skeptical when everyone else is euphoric.
And looking for value when others are blinded by greed.
That's so relevant today, especially with the rise of things like meme stocks and speculative frenzy.
So you're essentially saying Graham's principles are like a life raft in a sea of market craziness.
You could definitely say that. They help you stay grounded and focused on what really matters.
Finding solid businesses, buying them at the right price, and letting your investments grow over time.
It's about building a solid foundation rather than chasing quick riches.
Speaking of building a foundation, in this deep dive, we've talked about some key takeaways from The Intelligent Investor.
We've covered a lot of ground.
We've talked about the difference between investing and speculating.
The importance of understanding Mr. Market.
The defensive versus enterprising investor.
Margin of safety.
The dogs of the Dow strategy.
Inflation and pricing power.
And Graham's skepticism of new era thinking.
But there's so much more to explore.
Stay tuned, folks, because in the next part of our deep dive,
we're going to get even deeper into the strategies Graham outlines for enterprising investors.
We'll talk about how to identify those undervalued companies.
And delve into some of the more advanced concepts from the book.
So make sure you hit that subscribe button so you don't miss part 2.
You won't want to miss it. So last time we talked about a lot of the really key concepts from The Intelligent Investor.
We did, like defensive versus enterprising investors.
And the importance of margin of safety.
We also touched on Graham's skepticism of new era thinking.
Which, let's be honest, is constantly relevant.
Oh, absolutely. There's always some new craze in the market.
Right. But today,
we're going to dive even deeper.
We're going to explore the strategies Graham outlines for the enterprising investor.
The more hands-on investor.
One who's willing to put in the time.
To uncover those hidden gems in the market.
Exactly. So let's start with one of Graham's core principles for enterprising investors.
Okay, what's that?
It's the importance of truly understanding a company's intrinsic value.
Ah, yes. This is where the real detective work begins.
Exactly. It's not enough to just glance at a company's price-to-earnings ratio.
Right. We need to go beyond those surface-level metrics.
We need to delve into the financial statements.
The balance sheet, the income statement, the cash flow statement.
We need to understand how the company makes money.
How much debt it has. What its future earnings potential looks like.
It's about painting a full picture of the company's financial health.
Graham was a big advocate for looking at things like a company's balance sheet strength.
Absolutely. He wanted to see low debt levels.
And a consistent track record of generating profits.
That's how you find companies that are built to last.
Now, we also talked about looking for companies with a history of paying dividends.
Ah, yes. Dividends.
Many investors see dividends as a sign of financial stability.
They can be, but Graham had specific criteria.
So not all dividends are created equal.
Exactly. He was interested in companies that consistently paid out a reasonable portion of their earnings as dividends.
So it's not just about whether a company pays a dividend.
It's about the consistency and sustainability of that dividend.
It's a signal that the company is generating real profits.
And that they're committed to sharing those profits with shareholders.
Now, another fascinating aspect of Graham's approach is his focus on market psychology.
Ah, yes. He was really ahead of his time in understanding how emotions can drive market behavior.
It's like he knew that the market is driven by fear and greed.
He absolutely did. He understood that those emotions can lead to irrational price swings.
Creating opportunities for the savvy investor.
The intelligent investor who can keep a cool head.
And detach themselves from the market's mood swings.
Remember, Mr. Market.
Oh, yes, Mr. Market. the embodiment of market emotions,
We need to be able to see through Mr. Market's antics.
and make decisions based on logic and reason, not on our gut feelings.
Exactly. And that can be tough because investing is inherently emotional,
We're dealing with our own money, after all.
which is why Graham's principles are so valuable.
They provide a framework for making sound decisions, even when the market is going haywire.
Now, let's move on to another area where Graham's insights are particularly relevant for enterprising investors.
What's that?
Special situations.
This is situations.
These are often corporate events.
Things like mergers, acquisitions, or spin-offs,
Exactly. These events can create opportunities for investors.
because they often lead to mispricings in the market.
Right, a company might be undervalued before a merger.
And then after the merger,
Its true worth becomes apparent.
leading to a significant price increase.
Or a spin-off might create a new, independent company.
That's suddenly trading at a bargain price.
But it's important to note that special situations can also be quite risky.
Oh, absolutely. They're not for the faint of heart.
They require careful analysis and a deep understanding of corporate finance.
It sounds like analyzing these situations requires some serious detective work.
It does, but it can be very rewarding for those who are willing to put in the effort.
So the enterprising investor needs to be a bit of a financial detective
A market psychologist?
and someone who's comfortable with taking calculated risks.
But remember, even with special situations, it's crucial to stick to Graham's principles.
Look for strong fundamentals
Buy at a discount to intrinsic value.
and always have that margin of safety.
Because even the best analysis can sometimes be wrong.
And that brings us to another key concept from the intelligent investor,
What's that?
the importance of patience.
Ah, yes. Patience is a virtue, especially in investing.
Graham often said that investing is a marathon, not a sprint,
It's about taking a long-term perspective.
and not getting caught up in the short-term fluctuations of the market.
It's about letting your investments compound over time,
Now, besides the nuts and bolts of analyzing businesses,
which are obviously important.
Graham also had a lot to say about the psychology of investing.
Oh, this is crucial. Because our own emotions can be our worst enemy when it comes to investing.
It's like our brains are wired to make the wrong moves at the worst possible time.
Right. We get greedy when the market is going up,
We panic when it's going down.
leading us to buy high and sell low.
The exact opposite of what we should be doing.
Exactly. And that's why Graham emphasized the importance of developing a disciplined approach to investing.
One that's based on logic and reason, not on our gut feelings.
So it's about having a plan and sticking to it, even when the market is throwing a tantrum.
He actually suggested creating an investment policy statement.
A written document that outlines your goals, your risk tolerance, and your investment strategy.
It's like having a set of rules to keep you grounded.
When things get crazy.
What else did he suggest for managing those emotional impulses?
He was a big advocate for diversification.
Spreading your investments across different asset classes
Different industries.
to reduce your overall risk.
Right, that way if one investment does poorly,
It won't sink your entire portfolio.
it's about not putting all your eggs in one basket.
And of course, he emphasized the importance of having a long-term perspective
Remembering that the market is cyclical.
and that downturns are inevitable.
Right, they're a natural part of the market cycle.
Graham encouraged investors to view those dips as opportunities,
To buy quality assets at discounted prices.
rather than panicking and selling at a loss.
Exactly. It's about being greedy when others are fearful.
And he wasn't a fan of trying to time the market, was he?
Not at all. He believed it was essentially a fool's game.
Even the most experienced professionals consistently fail at it.
So instead of trying to predict the market's every move
It's better to focus on finding good companies.
and holding on to them for the long haul.
Now, Graham also had this idea that the investor's chief problem and their worst enemy,
Is likely to be themselves.
yes. Can you explain what he meant by that?
He understood that our own biases and emotions can lead us astray.
Causing us to make decisions that are not in our best interests.
We might hold on to a losing investment for too long,
Because we're afraid to admit we made a mistake.
or we might chase after the latest hot stock tip.
Because we get caught up in the hype.
Right, it's like we sabotage our own success without even realizing it.
So what's the antidote to this self-sabotage?
Graham emphasized the importance of self-awareness
Discipline.
and patience,
It's about knowing your weaknesses.
and putting systems in place to protect yourself from them.
So it's almost like personal finance meets self-help.
You could say that. And it's one of the reasons why The Intelligent Investor remains so relevant today.
Even decades after it was first published.
It's a book that not only teaches you how to invest,
But also how to think about investing.
and how to approach the market with a level head.
and a long-term perspective.
It's about understanding yourself as much as it's about understanding the market.
So we've spent the last 2 deep dives really unpacking the intelligent investor.
We've talked about so much.
From Mr. Market
To margin of safety.
to the differences between the defensive and enterprising investor.
We even got into the psychology of investing.
But now I want to bring it all together.
How so?
I want to talk about how these principles apply in today's world.
Because, let's face it, the market has changed a lot since Graham's time.
Oh, absolutely. I mean, we have things like cryptocurrencies,
AI-driven trading algorithms.
social media influencing investment decisions.
It's a whole new landscape.
So is the intelligent investor still relevant in this fast-paced, tech-driven environment?
That's the amazing thing. It really is.
Why is that?
Because Graham's principles are timeless.
You really think so?
I do. Take his emphasis on long-term investing, for example.
He always said that the market is a voting machine in the short run, but a weighing machine in the long run.
Exactly. And that's just as true today as it was back then.
So even though it might seem like everyone's making quick profits from day trading or meme stocks,
The intelligent investor knows that real wealth is built over time.
it takes discipline
Patient.
and a focus on the fundamentals.
And that brings us to another principle that's perhaps even more important now than ever.
What's that?
Understanding risk.
Because it seems like it's easier than ever to take on more risk than you realize.
With online trading platforms,
The complex financial instruments,
you can really get in over your head.
which is why Graham's concept of margin of safety is so crucial.
Oh, absolutely. It's your buffer.
Your protection against unforeseen events.
It's like an insurance policy for your investments.
Because even the best investors make mistakes.
And market conditions can change rapidly
That margin of safety helps limit your downside.
and protect your capital.
Now, something else Graham talked about that feels very relevant today.
Is the danger of market hype and speculative bubbles?
It seems like we're always in a bubble about something.
Right. We've seen it with the dot-com bubble, the housing bubble.
And who can forget the meme stock frenzy?
People can't resist the allure of getting rich quick.
But those bubbles always burst, don't they?
They do, and it's often the average investor who gets hurt the most.
But Graham's principles offer a way to navigate those turbulent waters,
They remind us to stay grounded, to focus on the fundamentals.
even when everyone around us is losing their heads,
It's about being skeptical
questioning assumptions,
and doing your own research,
which is more important than ever in the age of social media.
where everyone's an expert,
So the intelligent investor is really a guide to thinking clearly
making rational decisions.
and avoiding those common pitfalls that trip up so many investors,
It's about taking control of your financial future.
and navigating the market with confidence and wisdom.
Even in today's crazy world.
Well, on that note, I think we've covered a lot of ground today.
We have. It's been a fantastic deep dive.
We hope you found it insightful and helpful.
And that it's inspired you to pick up The Intelligent Investor.
If you haven't already.
Or to revisit it with fresh eyes.
As always, we'd love to hear your thoughts.
Leave a comment below. Let us know what you think.
And if you enjoyed this deep dive,
Be sure to like and subscribe to Finance Daily for more insightful discussions.
until next time, happy investing.